with us we have Abakkus Senior Fund Manager, Mr. Aman Chowhan. Um, Sir, I think we can start the webinar.
Sure. Thanks, Shailesh, and good evening, everyone. It's been challenging times in Indian equity markets for the last few months, and we thought it's appropriate to have an open discussion and engagement with anyone who is interested in hearing our views. So here we are. I'll broadly discuss what the current market scenario is, what are the concerns which are bothering investors right now, what's the key point highlight, and what's the outlook for Indian equity market. And we'll also touch upon the three portfolio schemes or the three strategies that we have on Abacus platform as to how are the strategies currently positioned, what is the current portfolio valuations, and what has been the, you can say, activity regarding this portfolio in these uncertain times. So, keeping this in the backdrop, let's start with something which is clearly relevant as to how the equity markets are and what's the reason for the current, you can say, hmm, the volatility that we have seen. So, as you see on the screen, clearly the last 6 months have been, you can say, difficult times or challenging times for the mid and small cap basket. What you see on the bottom here is the double digit negative returns in the last 3 months, which is basically, I'll say, more of profit booking than anything else. As we all are aware that last post COVID, in the last say 12 months, mid and small caps in India have done exceedingly well. People would have at least doubled or tripled their money in most of the mid and small cap schemes that they would have invested into. Individual stock performance would be even different. So it's more of profit booking, I will say, rather than a correction or rather than something which is materially different. Obviously, markets were at a high a few months back, and the valuation there was also high, especially for the mid and small cap basket, which we all have been highlighting. And there has been an almost consensus call that there is going to be mean reversion. Large caps will do better than mid caps, at least in the near term. So that seems to be faring out as we speak. But I feel it's more of profit booking than anything else. That there is no systematic worry or there is nothing specific for the higher mid and small cap correction. They went up higher, the valuation was higher than large cap, and obviously when the market corrects or when there is profit booking in the markets, the mid and small cap will tend to give away some of those gains, which is now happening. If you look at the 3-year returns, mid small cap returns are almost double of what the Nifty returns are. So in spite of this near-term underperformance, overall, over the 3 to 5 year basket, they have delivered returns which is almost 2x of what the benchmark returns are. And hence, what you see today is more classified as profit booking by us than rather correction in the mid and small cap space. What has also happened is that Indian markets, which were among the better performing or the best performing markets within the region and among the emerging markets, have given away some of the gains over the last 1 year or so. If you see last 1 year, Nifty returns is 7-8%. Well, we see at least there are 7-8 markets which have delivered strong double-digit return, mostly in the region, which is Hong Kong, Singapore, Taiwan, which has happened post the rally that we see in China when the China government announced the stimulus, where a lot of money moved away from other emerging markets and got into the Chinese markets. When bearing that, other markets were either flattish or some markets even negative. So in a way, we are okay in way, but not the way we were 3 years back when India was among the top 5 performing markets. So the last 3 6 months, especially, we have given us some of the alpha that Indian equities have delivered, and hence the last 1 year now we would be mean or slightly below the mean average as far as the peer group or the emerging market is concerned. So the reasons behind this correction is something which will be more important. We'll come to that. And one of the key points being highlighted or being discussed is that FI is selling. That FIs have been selling continuously in Indian equity markets for the several months now, and that is one of the key reasons why the market has underperformed. We have a slightly different view here. If you see the table here, in calendar year 22 also FIs were net sellers, right? Still the markets did well. It is not that it is only FI selling. And even right now, in the last year, when you see calendar 24, when we talk about $15 billion of FI outflow, what media highlights and what people discuss is basically the secondary market sale by FIs. We are not counting the money the same FIs has put into the IPO markets or in the QIB markets of India. right? As we all know, over the last year and a half, IPO market has been very vibrant in India. Almost every week there are at least two to three IPOs that has opened up, out of which one or two IPOs are decent IPOs worth investing into, where FIs have actually invested. So they've invested close to almost similar amount into the IPO market, which is also a record high, right? So last year, calendar year of 24, FIs invested an estimated $14.5 billion of money into the IPO market, right? So if you compare that versus this selling, net FIs are not sold anything meaningfully in India. It is not that they have been selling and this is the primary reason for the markets to correct. Yes, definitely every year we saw net inflows by FIs versus that when we see a neutral or marginally negative number from FIs on a incremental basis, yes, there is a negative impact, but it is not that it is because of FI selling that the markets have corrected. If we see the global trend also, the regional trend also, what we see as an outflow from India is hardly anything compared to what we have seen the outflows from say, other regional markets, say like Brazil or Malaysia, Philippines, Taiwan, Thailand, Vietnam. They all had numbers much higher than what the Indian equity markets have seen, right? It's only the you can say the South Korean market which benefited from the tech and the semiconductor boom that we are seeing right now, which have seen net inflows in the region. Otherwise, broadly, FIs have redeemed or taken money out of emerging markets in the last year. The reasons for that we'll discuss in detail subsequently. So then, if it is not FIs, then what exactly it is? We believe the key reasons for the markets to see the volatility that it has seen in the recent past, besides the global event, has been the slowdown in India. This is something which is now being talked about much in detail over the last few months, but it was clearly visible 4 5 months back when we had the second quarter number GDP coming in at 5.4%, which is a 7 quarter low. Right now, keeping this in context, India was always a high growth market. Indian markets always traded at a premium globally as well as locally. Invest in India for the high growth potential. And this premium was sustaining because the growth rates were sustaining. When growth rate started to decelerate, the rationale for this premium disappeared. Anyone looking to invest into India would say that fine, we like Indian equity markets, we like Indian stock, we like Indian companies, but not the price at which they are trading. If you're growing at 20, 30%, I don't mind paying you a premium. If you're going at 5, 6, 7, 8%, then I'm not that happy and I'm not interested in giving a high premium to Indian equity markets. And that is one of the reasons why there has been, you can say, lack of buying or profit booking or money moving out of India by the FIs. Also, the other reason to worry has been the low corporate profit growth. So the reflection of the slowing GDP was reflected in the corporate profit growth also, right? And that is also one of the key reasons, along with the GDP, they are both interlinked, that the investor interest in India reduced or waned away in the last few months. Now, what has led to this slowdown in the near term? We all know some of the reasons. One was the election, which impacted government decision as well as spending in the first half of current year or the first half of the last calendar year. Now, that seems to be reversing as we speak. We have seen the budget numbers for the first 9 months. The capex spend of the government is not very high, but they have kept the annual budget numbers pretty high, which means that in the fourth quarter, they're going to spend meaningfully on that. Also, the expected recovery from the rural markets of India, where this year monsoons have been good, MSP prices also have been good, and it is expected that the rural economy will fire in the second half of the current year. That has not happened. In the first half of this year, when we spoke to corporates, companies, or anybody we would have spoken to, they would all have said that in the second half, Indian economy should do better because this year, Diwali was expected to be very good, followed by a very long and very heavy marriage season session. And because of this, we are expecting the consumption demand to be higher in India because of the marriage season. That so far has been very limited or very patchy, or it has been concentrated in certain pockets only. It has not been a broad-based recovery the way one would have thought. So a combination of both government spending slowdown as well as demand impact at the bottom of the pyramid at the mid-level segment of India due to high inflation is what has resulted into this slowdown. The luxury market of India, the urban market, especially the higher class of India, they continue to do well. They continue to spend. There we are seeing good high double-digit growth. But the mid market as well as the bottom of the pyramid demand in India is something that has got maximum impacted because of the high inflation. So this is broadly the key reasons why we see that the markets have been volatile. Now, as we speak, post the current correction that we have seen in the last few months, the valuations in Indian markets are now back to the 10-year average that it has always traded. So, as we see in the chart on your left top, this is what the Nifty PE is, and the 10-year average is 19. Indian market had gone to as high as 22, 23. It was always trading or a premium over the last 2, 3 years. Now that premium has come off, both because of time correction and because of the correction in the market. The price to book is also showing you a similar trend where the market, because of the correction, we are back to the 10-year average, and there has been a near-term impact on ROE also. The ROEs which used to be north of 15, 16% have come back to say 13.5, 14%. So it's not a very meaningful impact on the ROE, but we have seen a meaningful impact on the valuations, which means that the profitability of corporate India is still intact. Demand has not picked up, and hence the top line growth has been sluggish, leading to sluggish earnings growth, and hence the correction in the market, leading to correction in the P and the PB ratios. Coming to sectoral wise, it's always good to see that broadly what has been the market valuations, but ultimately we all invest individually into stocks or into sectors where each sector has a different, you can say, performance, different valuations, different outlook, and hence at any given point of time there will always be some sectors that are doing very well, and there will be some sectors where the performance has not been so good. There will always be some sectors the valuation is pretty high. For example, in the last say year and a half, PSUs, railways, defense companies were the come sectors which were in limelight, where maximum money and maximum interest, investor interest was chasing these stocks. Now, prior to that, it was IPO. Now the scenario would have changed. Most of the stocks would have corrected 20, 30, 40% from the high, and some new sector will emerge, right? So there's always some sector rotation in Indian equities, not just in, frankly, Indian equities, even globally. And this is what we are going to see in the current scenario also. Whenever the market recovers, which we expect in the next few quarters, a new sector would be emerging. Now, what is that would depend on how the earnings growth pans out and what is the valuation for these sectors. So as we see, we have seen maximum re-rating as well as correction happening in the capital goods sector, where in the last 3 years we have seen massive re-rating, 15p going all the way to 45, which has now come back to 35. Autos is reasonable. It is still near its, you can say, average valuation, whereas we see private banking, the valuation is now meaningfully off than its historical average. We have seen these valuations not many times except in the COVID times, and hence this is something that is looking interesting to us. Private banking as a sector, both fund-based financial as well as non-fund-based financial in the private sector is something that is now, I can say, a preferred sector choice for us. It was always high exposure for us. This sector has been market performing. Frankly, it has not delivered the kind of alpha one would have expected. But for now, as the rate cut has started, we expect this sector to start doing well. When you come to PSU banks are also, which had got significantly re come back to the average, but they've always traded at lower valuations versus private, and hence our preference would be more towards private than PSU banks. Pharma is still strong, and tech in that way, the valuation is still higher than what it is in spite of the small correction, predominantly because of the currency. At 87, 88 levels, exporters benefit maximum, and in Indian context, pharma and IT are the two sectors where we see the maximum export exposure, and that is the reason these sectors seems to be doing well. This is also something which is of preference to us. We would be looking to increase the exposure into both these sectors because we expect the current level to sustain, and the benefits of the currency to be started reflecting to the company's numbers over the next 6 months. So every company would have some forward contract, every company would have some old date contracts, which will get renegotiated over the next 3, 6 months to the higher rate, and 87, 88 would be the new base case scenario for the INR, which will then start getting reflected into the numbers. So that's the reason we feel over the next 1 2 quarters, the actual benefit of the currency will be visible in both the pharma and the tech sector. Consumer staples always traded at high valuations. Post the budget, we saw a good rally into most of these names. Some of the rally has got fizzled out in the recent last few days of volatility. But overall, it's a very stable valuation sector. Uh, it's not something which is super, you can say, exciting as far as valuation is concerned. This sector now trades on an average 40-45 P. While the budget has given a big impetus on consumption, we feel that consumption impact will be more visible in consumer discretionary, where the valuation is also similar to where the value, you can say average valuation is, and less on consumption. If you have more disposable money, you're going to spend more on discretionary. Staple is something that you're anywhere spending. You're not going to eat double just because you have extra money. Yeah, but yeah, you might go out and buy a brown good, a refrigerator or a TV or a car or something else from the extra money that you're going to save. So this is one sector where things are looking pretty interesting, especially post budget. But yeah, valuation is always stayed higher, continues to stay higher, and hence one needs to be very selective. So over the next few months, we plan to invest into 1 or 2 names in the consumer discretionary sector wherever we feel that the valuation is reasonable or where the risk reward equation is favorable. We're not just going to blindly buy into the consumer discretionary sector just because of the budget that has come in, where we have seen that government's clear focus was in trying to revive the consumption. So what you see on the right is the table, which is where the sectoral performance is. As you see, uh, for the last 1 year, it's been a very varied sector performance. IT has done well, consumer durables have done well, auto has done well, healthcare has done well, whereas media is the only sector which is negative. Oil and gas, PSU banks, private banks have been single digit. So this is where the maximum impact is. FMCG is flattish in the next 1 year. And if you see the 10-year average also, it's been all over the place. So every 2 to 3 years, we see a sector rotation happening in the market, and we expect the same thing to happen this time around also. The old favors of railway defense might still do well, but they might not be leading the recovery. They might not be the best performing sectors whenever the market recovers. And hence, currently in our portfolios, we don't have much of these exposure, and we're not looking to add also into these exposures. So as I mentioned, the sectoral preferences is banking, both fund as well as non-fund based, IT, pharma, consumer discretionary, and even for that example, EPC companies, because we expect the government spend to go up meaningfully coming this quarter and in the subsequent quarter. So the companies that benefit out of this will also be something where our focus would be. So this is broadly how the sectoral valuations are. Coming to now, what's the outlook for the market, especially post the recent correction? Few updates. We all know about the budget. There is no point discussing more about the budgets, but the point here is to it is that one, the government is rightly focused on the consumption because this is what was dragging the GDP, you can say growth. The capex activity in India is much higher than what it was say 5 years back or decade back. But what was lacking was the consumption, which the government is rightly focused and targeted in the budget. There has been too much of media been saying that government is focused only on the consumption and not on the capex, and capex is something which has a multiplier effect, and infra creation should not be ignored. We feel the government has not ignored it. The percentage of capex versus the GDP has remained the same, right? Which means that the government has not ignored it. Yes, government has not added additional impetus to the infra creation, which we feel is because of the constraint the government faces. You can't have a tax break at the same time generate more revenue, which can be used for spending also, right? So you can't get that trinity, especially when the global markets are volatile, when there is, you can just slow down globally, which is also impacting, plus the uncertainty regarding the US trade tariffs and how the global world is going to respond to what the US is doing, right? So keeping that in mind, we believe that government has been able to strike a fine balance in trying to revive the consumption, which we believe which would be visible over the next few quarters. At the same time, uh, maintaining the momentum it has created into the infra spend. Now, infra is something which the private capex can also come in and contribute, which so far has not been happening to that level. Consumption is something which only the government can do. The private sector cannot come and contribute that, and hence the government is rightly focused there more in this budget versus infra. With some tweaks in the policies, but some changes, the government is hoping that the private sector will come in and chip into the growth in the capex or in the infra spend also, which we find is a credible, you can say, assumption. Also, with already the first round of rate cuts already behind us, we feel that liquidity also has got you can say addressed by the RBI, and that is also going to add on into the momentum which the government is trying to build, which we feel the government is not budgeted in its budget documents, which got presented a few days back. So the realistic numbers have got presented into the budget, and we feel there's an upside case for the GDP numbers to be revised higher than what the government is projecting. Because if somebody has to just see the headline number of 10% GDP growth, which is what is broadly what is going to be in the current year also, there is not much of acceleration they are seeing. Though on a sequential basis, we'll see a growth because 2Q current year was 5.5, and then things are going to further improve. So sequentially, we'll see growth. Overall, we'll not see growth on a YOY basis for the full year numbers, which we feel there is an upside risk to that because the benefit of the rate cut, I believe the government is not fully factored in into the budget document, maybe because of the timing issue or something. So keeping in mind, I believe the budget has, you can say, kicked off the key, you can say, trigger to revive the demand. And let's see over the next few months or say next 1 or 2 quarters how this thing spans out. Inflation is pretty comfortable now in India, and that is also should start to help into the demand recovery. We've seen a very high inflation phase in bulk of 22-23, and the impact of that was visible in FY24. If things normalize the way it is in FY24, maybe the next calendar year we'll see things getting better because the inflation expectation will get readjusted both for the urban as well as rural India. Uh, we have seen a similar trend in US markets also, where US inflation is off from its peaks, and that would give some space for the federal there to further have some rate cuts. Though prior to Trump getting elected, there was expectation of 100 to 150 pips of rate cut, which now seems unlikely considering the way the US government is planning tariffs. So if you're having tariffs on your imports, which means that you are importing inflation. Whatever you purchased earlier or bought earlier for 100 now becomes 120. And ultimately, this is something which the end consumer or the you can see the population of US has to pay, which will lead to inflation, right? So this has to get adjusted by the currency, and you can't have a very low interest rate. Otherwise, the currency appreciation won't happen. So the US Fed and the US government has to also manage their currency, their inflation expectation and interest rate in a way that things are stable out there. And hence, the old expectation of 100, pips of rate cut might not happen in US. But whatever little window they have, if US goes ahead with the further rate cuts, then that will give room for the Indian central bank to also consider further rate cuts. Right now, the RBI is also constrained because if it cuts rate aggressively, it will have a run on the currency, which is already hitting new highs, right? So it has to maintain that balance also. But overall, India is well placed as far as the forex market is concerned. While currency has hit 86 half as we speak, it's still amongst the best performing currencies. Bulk of the depreciation that the INR has seen has happened because the dollar is appreciated. The dollar is appreciated versus most of the other currencies. What you see on your screen, you're seeing that the Brazil real, the Mexico, the Turkish, they're all depreciated in double digits, whereas the Indian rupee has depreciated only 3.5% versus the dollar in recent time. And this is exactly what the Chinese currency has depreciated. So one has to look at it in this way that the RBI or the government will allow rupee depreciation to the extent the Chinese currency also gets depreciated because we need to maintain that competitiveness versus China. It is more to do with dollar appreciation. So tomorrow, if China allows its currency to depreciate further, there will be a pressure on Indian currency also. And I believe the RBI will be lenient in that sense. But if it happens that the INR currency depreciates on its own versus, say, corresponding action from the Chinese currency or other currencies, then I believe the RBI will step in much more aggressively to stabilize the rupee. We have decent forex reserves with us. It is almost at historic highs. And also for the first time, if you see that the export revenue of India, which is the IT, predominantly the IT sector export revenues of India, have now surpassed the oil import bill of India. So earlier, under trade deficit basis, the biggest risk or the biggest discussion point was that oil is the biggest import bill of India, and if oil is volatile, then it will have an impact on the trade deficit that India has. Now, because of the almost 20% ethanol blending plus progressive action by the government, we have seen and steady growth that the Indian IT sector has seen, and that export income is now more than the oil, you can say, import bill. And this also is bringing in much more stability on the trade deficit front. And that is also one of the big reasons why Indian currency is amongst the better performing currency. Overall, we feel INR will remain a depreciating currency because ultimately it is the interest rate differential or the inflation differential that we see. But and if you see the historic trend of INR, there's always been 1 year where we see a sharp 3-4% depreciation, then 1 or 2 years in the markets, the currency markets are flattening, and then again we see a step up into the currency. We had 80s, 80s going to 84, 84 is now gone to 87, 88. Expect the currency to stabilize in current range 86, 87, 88. Maybe it can go to 89. But this time around, it is predominantly US dollars. So if DXY appreciates further, there can be further pressure on the INR, which not much can be done because for that. So that is definitely one of the major reasons for the FIs to book profits also. So early in my presentation, when I mentioned that the FI selling is also because of the view on currency, this is what has happened globally. That they have redeemed from emerging markets or other markets, and global liquidity has flown into dollar currency or the dollar currency investments. If you're invested, say, in dollar currency and you make a 5% return and you have a 5% dollar appreciation, you make a 8, 9, 10% return. Same thing if you invest in an INR or say in the Brazilian market or say in an emerging market where you make 10% and you lose 4, 5% in the currency, then still you make a net 5, 6%, which is lower than one can potentially make in the US markets. And your markets are also rallying, right? So they have also been a bull market in US where most of the top companies or the index heavyweight companies are seeing good global, you can say, profit growth. The likes of Microsoft, Amazon, Tesla, Apple, we all know the top corporates of US, they all seem to be doing well because they're gaining market share globally. So keeping that in mind, a lot of liquidity has moved towards dollar assets, and that is also one of the reasons why we are seeing, you can say, a redemption of profit booking from FIs within the whole of emerging market space, not just India where they have sold. So oil is not negative in India, where we are seeing a slowdown. There's robust GDP collection which continues. We see the highway activity, construction activities, railways, the digitalization theme which is there in India. They, uh, they all are seeing decent positive growth. So it's not that everything in India is on a slowdown and it's like a scary situation. Don't think so. Some pockets were overheated, some pockets did get impacted by inflation, but some pockets continue to do well. And we feel it's more of a transitional nature in what we are seeing, all which we are going through right now. It's more of a cyclical slowdown that we are seeing than a structural slowdown. I'm sure the government is aware of this. They have addressed this in the budget, and going ahead also, if the demand doesn't pick up, I expect the government to take the right measures to try and spur the demand in India. So with the Modi government in place, which is still you can say a pro-growth government, and with the recent win in Delhi, I believe the confidence level in the party also would be strong for them to take any bold actions if they need to. And hence, I'm not unduly worried about this slowdown. I feel it's more of a cyclical slowdown than a structural slowdown. So, net net, keeping this into the backdrop, what is the equity outlook in India? We feel in the near term, the current uncertainty regarding the announcement the Trump government is facing will continue. What so far we have been listening or acting or responding was what the US government is doing. We have yet to see retaliation in a meaningful way or countermeasures being taken by other economies in a meaningful way. Everybody is waiting for the Trump administration to execute or to sustainably uh, act on what they are speaking right now. Right now, it's more of announcements. Maybe it's more for bargaining. Maybe it's more to for positioning. Once the policy announcement comes in, it gets ratified and is there for the next 3 6 months. Is when I feel then people will start to respond because then they know exactly what is the problem that they need to address. Because of this, the near term can remain to be volatile the way it is. Indian markets will face or will act as per what the global markets are. So if the global markets were to correct, Indian markets will also follow them. The relative outperformance Indian equities saw over the last 2 years might not be visible in the near term because, as we have discussed, there is slowdown in India. But we are not going to be a completely outlier kind of thing that where the US market is down 5%, we are down 15%. No, that's not going to happen. Earlier, the scenario was if US markets are down 5%, we might be down 2 or 3 or 4%. Now it could be the US market is down 5, we could be 5, 6, 7%, but not 10, 15%. So in the upside also, if the US markets were to rally, I believe soon the Indian markets will stabilize and can resume the upward move. It might not be a V-shaped recovery that we have seen in the past, but still there can be a decent recovery which is coming. So what has happened in India, practically speaking, over the last 12 to 18 months, is that there has been a lot of retail participation that has come in, both through the mutual fund or the SIP route and through the direct equity participation. Bulk of this money has come into mid and small caps where we have seen the maximum impact. Earlier, what used to happen is that last year the budgets came in, capital gains got rate got increased, markets corrected for 2 days, people came in, bought in, they made money. The market is a V-shaped recovery. Modi government didn't get the number of seats that they expected in the elections. Market was volatile for the few days. You bought in, you made money. This time around, when the markets corrected, you did the same thing. You bought in, and the markets further corrected because of the global events plus the slowdown. And now people are stuck. Hence, the ability to retail to pump in big liquidity or to get that confidence back to buy aggressively is not there. I believe liquidity is there, but that confidence to buy aggressively is not there. People are not in a hurry to buy anymore. You show me growth, you show me decent valuation, then I'll come and buy. Otherwise, I'm happy to be on the sidelines. That is where what the market outlook currently is. That's what the investor perception of mindset right now is that show me growth, show me the numbers, show me decent risk reward equation, and I will put in. Liquidity is there, interest is there, yeah, but the aggression is no longer there. We feel that in the next few quarters, there will be sequential GDP recovery, which is going to be the next big, you can say, positive for the markets. Also, if things don't work out, then there could be further announcements from the government as part of the month. That can also be a good positive trigger for the markets. So this is where the whole hope is staying on. The macro positives that globally and the global trade, we are gaining market share at the expense of China, the China plus one strategy, the PLI scheme that we all talked about 6 months back to the last 2 3 years that the government has taken the right step, they all are there. The PLI scheme has been successful. We have seen good amount of manufacturing coming into India, pickup happening, dependence is reduced. All that macro positive stays. Just that the momentum in that is slightly soft, which we expect to come back. So there's no degrowth, there's no negative growth, there is nothing which is, I can say, a large deceleration percent. Just that the momentum is slowed down is what it is, for which the markets have given away the premium valuation that it has. So it's a natural reaction. Now the premium valuation will be back or the normal valuation will be back once we see the growth. If the Indian markets or the corporate India shows 15 16% earnings growth in FY27 or FY26, then uh, the markets will take a note of it, the investors will take a note of it, and it will be reflected in the valuations. Why we feel that the corporate profit growth can be better than the GDP growth is one of the reasons that post COVID, the general trend that we are seeing is that the formal economy of India is gaining market share versus the informal economy of India. The cash parallel economy of India is losing its market share. And in stock markets, only the formal economy gets represented. Because of this reason, we feel that the corporate profit growth, at least the formal corporate profit growth in India, can be better than what the GDP numbers are. And if that were to happen, then I feel the Indian equities will resume its up move. Coming to the valuations front, we are now back to the fair valuation zone. We are not a cheap market. Let's be very clear. India never was a cheap market. Versus peers versus other emerging markets, also Indian equity is always traded at a premium for a simple reason that the ROC in India is higher than the peer group. The longevity of growth visibility in India is also one of the highest. And the macro positives that we have, which is the demographics and the middle class and the working population in India, which is going to get productive over the next few years, is something which is unparalleled, something which is not there anywhere else in the world. And hence, Indian equity is always traded at a premium because of these reasons. These macro factors stay, that premium is gone, and hence we now need some triggers, we now need some positive news for the valuations to come back. So it's not a cheap market that one can expect a similar return of what we have seen in the post-COVID years, which was like very high 30-40% kind of returns in the broader mid-market and high double-digit returns from the top line or the frontline companies. But from a fair market, one should expect a fair return, which is somewhere mid-teen kind of a return. It's not going to be linear. The way we have seen in the past, it's never a linear return from equity markets. Currently, it could be flattish, it could be marginally negative also. But if one has a 3 to 5 year look, I'm not saying have a 10-year or a 20-year outlook. That is also positive, but nevertheless, at least in the midterm, 3 to 5 year investment horizon, in the near term, markets could be flattish, but overall, I feel a mid double digit kind of return on a CAGR basis is still possible from Indian equities because that's broadly what is going to be the corporate earnings growth of India. Even if GDP were to stay at 10-12%, the corporate India can grow 15% plus, and that eventually will get reflected into the corporate earnings. So that's where we are, where we expect a decent return from current levels. It's not going to be eye-popping the way it was in the past. Uh, we see upside risk to the government assumptions, to the growth assumptions. If things were to improve, it can meaningfully improve, especially post the rate cut, the liquidity measures, and the benefits of the budget announcement that has come in. We feel GDP can be higher than what current government estimate or the RBI estimates are, which can also be a good trigger. Some of the things one needs to be watchful is the corporate earnings. We are midway into the December quarter earnings. It has been a mixed bag. There are not been significant downgrades per se because investors, as well as the sell and the buy side investors, have, you can say, reset the expectations post the second quarter numbers, right? So nobody was expecting a very high growth in 3Q or 4Q, and now the earnings are coming broadly in line with what the expectations were, which anyway is a lower expectation, but yeah, at least we are not seeing negative surprises per se, which is good that the expectations is lowered down. Return expectations are also lowered down, and hence any positive trigger or any positive news can have a decent positive impact on the markets. So that's what everybody is hoping for. Though we feel that at least in the near term there is not much to look forward to. So those positive triggers are still some time away. It's not like 5 years away or 3 years away, but a few quarters away. Once numbers starts to come in, uh, FIs will also come back. Is clearly what we feel. We also feel that the FIs will come back for a simple reason that for them also globally, if one has to invest beyond the dollar, there are not much of options left per se. If you look at Asia, our neighboring countries are bust. Pakistan is bust. Sri Lanka is bust. Bangladesh is not in the great shape. Nobody wants to increase the exposure to China, though we had a trading pop coming into China. It has not continued in the sense that Chinese rally has now flattened out the process, right? So you're not making any incremental gains from China. So there are not much of options, maybe a Philippines or a Taiwan market. If you look at Middle East, it's predominantly oil. Europe is still in low demand or mild recession per se. The Russia crisis continues. Commodity-based economy like Brazil, Indonesia are also decelerating. So from an investor or a global investor standpoint, there is not much of options. And within that, India stands out. Just that the dollar and the currency should stabilize and they should start looking beyond US or the beyond dollar assets. Right now, because of Trump, because of the policies, because the way momentum is, current momentum is buy dollar assets, buy dollar investment. Don't look at non-dollar investments. But that can change quickly. As you all know, every 1-2 years the narrative changes, the outlook changes, the sectoral preference changes, and that's bound to happen in India also and globally also. So it will all depend on how the Trump administration is able to handle the tariffs that they are announcing. You cannot have a situation where you keep on announcing tariffs and there is not going to be a backlash, both locally as well as from the global trading community. So tomorrow, if you have a blanket, you get a tariff, there is going to be counter tariff measures also, which is going to happen, and the other countries will also impose tariffs on US exports, right? So plus you will be importing inflation, which nobody wants. No consumer anywhere in the world would like a high inflation, right? So I believe Trump is a businessman. The way his first term was, he understands economics, he understands business better than most of the other politicians. He's also a pro-growth guy. So there's something behind what he's doing. He also wants more of manufacturing to happen in US, more of self-reliance, less of import, everything exactly similar to what Modi in India is trying to do. And there's nothing wrong in what you're saying. But you can't do it in a haste. You can't do it in a way they are currently doing it. They know it better than us as to what they're getting into. I'm sure they will, once the dust settles and once things stabilize, things will start to look up. So that's broadly what one should be looking forward to. Uh, this will also have an impact on the global liquidity and what inflows Indian markets see. And let's till that time, it's wait and watch. Domestic liquidity is strong. People sometimes worry. They sometimes ask me right now, that there's still inflow, there's still SIP, though SIP is slowing down, but there's still positive inflow. What will happen if there's redemption? Who will buy? I'm I don't think we are getting into that scenario as of now. Maybe there could be 1 or 2 months of redemption or something, but I don't fear that much because it is not the first time Indian equities have been volatile. Every year there's some event or something where the markets are volatile and they recover very fast. The only difference this time around is the recovery has got prolonged and the drawdown has been steeper than what one would have expected. But the investor class in India is also matured. The retail India or the retail investors have seen remarkable, you can say, understanding over the last few years. And I'm sure that is not something which is temporary, right? So everybody understands the compounding effect. Everybody understands whoever are investing into equity markets as to what they're getting into. Yeah, there will always be some people who are here for quick gains. They'll come quickly, they'll go quickly also. And that will lead to the near-term volatility, but I don't expect redemption pressure or a meaningful selling pressure to come into the Indian equities. So uh, we are neutral to, you can say, cautiously optimistic on the markets. The cautious optimism is because of global reasons. Locally, we are confident that growth will pick up. It's not going to be meaningful acceleration, but at least the bottom has got created, which is good enough. Equity markets are always forward looking. Once they start seeing initial green shoots or initial signs of things picking up, I'm sure the markets will take a note of that. So net, fair valuations in markets right now, and from fair markets, you should be expecting a fair return, not a super normal return. If policies change, government acts, something happens globally as well as locally, this number can even be higher, the way we have seen in the past, and that's what the excitement of equity markets is. What we're talking about, mid-teen kind of return, is a base case return expectation one has. There is always an upside possible to this, depending on how the policy gets framed and how, you can say, investors react to the news flows and to the overall sentiment. So that's the near term as well as the midterm outlook to India. And uh, as I said, in the near term, let's it more to do with how the global markets as well as what the Trump administration is up to. We indirectly discussed this as to what could be the risk. Geopolitical is always there, global slowdown, currency, and obviously the oil prices, which still has a sentimental impact on Indian equities or the valuation at which Indian markets trade. So that was broadly on what our view on the market is. And coming to equally important point as to what we are doing, how are we handling this current volatility and what's our positioning. I'll quickly take you those details. Before that, a quick recap in the interest of people who are interacting with us for the first time or are not very well versed as to the philosophy that we follow. And we follow this philosophy in a very disciplined way across all the strategies that we have. This is broadly what you can say the Abacus platform or the Abacus philosophy is, which is first and foremost, we don't believe in benchmark style of investing. We just don't believe in cash allocation. I'll invest only and only if I feel I can make a decent return from an investment. Else, happy to be on cash. And since I don't follow the benchmark style, I'm not compelled to own the obvious popular names in India just because they are part of index. I need to be convinced to be buying them. And hence, you might not see the obvious popular names in my portfolio versus the peer group. For example, you might not see uh, you can the ITCs or the levers or the Infosys or Reliance of this world. That might not be there. Uh, we do only fundamental style of investing. So there's no technical, there's no derivative, there's no momentum trading that we do besides fundamental investing. If you look at my portfolio, almost 30% of my portfolio are stocks where we are the first or the only institutional investor, which means that we generate our own ideas. Uh, we have a large investment team which is constantly uh, on the ground trying to look at new companies, new management. We don't have any passive strategies. Everything is actively managed. Every stock in the portfolio is monitored on a daily basis. We are also long-term investors, but my long-term definition is 3 to 5 years. It is not 1 year, it is neither 10 years. Whenever we invest the 3 to 5 year view, and hence our performance should be tracked based on this time frame of what we invest into. And sixth and very important is we are value conscious investors. I'm not a pure value investor that I'll invest into 5p or 5% dividend yield stock, but at the same time, I am shy to pay extraordinary premium just because you're the market leader or you're the market favorite stock. If you're going at 10-15%, I don't mind paying even a 20-25p, but I definitely do mind paying a 70-80p, right? Which is true for most of the obvious popular names stocks in India. So that is something that clearly we are shy of. What you see on the screen is the all cap portfolio, which is a combination of large cap and mid cap portfolio. People do ask us that now since large cap are doing well, is this going to be 100% large cap portfolio? Are we moving from mid cap to small caps? No, it is not a multi cap portfolio. It is a large plus a mid cap portfolio. And we stay true to the strategy. As we speak, around 60-65% is large cap. The rest is mid and small cap exposure into this portfolio. 53% to be precise is large caps. We have 6-7% cash into the portfolio, and we have strategic 7-8% of small caps. Completely sector agnostic. You see the current sectoral exposure there. Pretty diversified, 30-32 stock portfolio. What you see on the right is the top 10 holdings. Not the obvious names, but some of the names, these are not new companies, these are all known companies. My reason to own them would be different. And this is what the performance is. Clearly, last few months, markets have been volatile and has had an impact on the portfolio also. So we would be underperforming, and though it's a non-benchmark, but still, just to give you a context, last 1 year we have not been able to generate an alpha. Last 2 years now, because of this, we are flattish. 3 years since inception is still a positive. Since inception, and an absolute number, we are still generating a decent return. Once market stabilizes and we see some uptick in market, we are sure that we will be able to recover the near-term underperformance, and that will have an impact on the long-term performance also. This is what the emerging portfolio is. This is a dedicated mid and small cap portfolio. Similarly, well diversified across companies, across sectors. The top 10 holdings are on your right-hand side. Different names, not the obvious popular names, but each and every stock has a reason for which we have been owning them. This portfolio, though the mid and small cap has been on the receiving end, on a 1 year basis, this portfolio is still doing well for us in spite of the, you can say, near-term underperformance, especially in the last 1 and 3 month numbers. Since inception, this is still doing pretty well. We are almost 2x of what the benchmark or the broad market returns would be. The third portfolio, before I come to the third portfolio, most important thing is what the valuation is. I might tell you that we have a portfolio which has a decent growth and we are not overpaying for it. It's a reasonable growth and a reasonable uh, valuation portfolio. This is what the proof of the pudding is. My all cap approach portfolio is currently trading at 19 times forward earning, which is broadly what the market valuation would be. But my PAL growth is significantly higher than what the market growth is. The ROE is 15%, debt equity is 0.5. So we have a much superior growth and with a similar valuations that the broad markets are trading at. The mid and small cap portfolio is also trading at a similar valuation, but the year the PAT growth is much higher. So smaller companies growing faster, For a 25% CAGR company, I believe 18, 19 times of forward earnings is still pretty reasonable. So we have been able to strike a decent balance between growth as well as valuations. The third strategy that we have is the adder strategy, which is a 40 stock portfolio, very well balanced. And we all know that in this portfolio, we invest in the full spectrum of the market, which is large, mid, small, and micro. So these are our top 10 holdings, 30 to 40% overlap versus the other two strategies that we have. Well diversified. This is one of the newest strategy that we have. It's just been a year or so of launch, and the recent 3 months has been volatile for us, and that is what has impacted. This has a 15% cash component to it. So this we are going to judicially deploy over the next few months, and that is what we feel will help us in the recovery that we are expecting into this portfolio. This is a team, broadly, we all know most of them. And I think I'll take a pause here. We have still some time left for Q&A. Please, any queries that you have besides stock specific queries, uh, put it into the chat box. We'll try to address as much as we can.
So the first question is, with a volatile scenario since last 2 quarters, with inflation, low consumption looms around inducing tariff war, it will be keen to understand the outlook for the next 2 quarters, and when can we see some recovery, and what should be our expectation for an AIF investment we had done.
So as I mentioned, recovery is more now in FY 26. So we're already in Feb of 25. The FY 25 is already over. We are not going to see any sharp recovery in 3Q or in the current 4Q. Government is going to spend in 4Q with pretty aggressively. The benefit of that would be partially visible in 4Q, more in 1 and 2Q. So the first half of FY 26 is when we'll start to see things recovering, and that should be noticed by the market, and the market should act accordingly, is what we feel. It's a fair, I've already answered it. It's a fairly valid market as of now, and hence one should be expecting a fair return, which is like a mid-teen kind of a return from equity markets from these levels.
Second question, which are the sector you see to do well in next 1 to 3 years?
Financial is something that we are pretty excited upon. IT and pharma, because of the currency benefit, a sustainable benefit of currency, not just one of benefit that they're going to see. That is also looking good. Sector which will benefit from government spending, EPC companies, infra companies is also something that we like as a sector. We are neutral on oil and gas, we are neutral on metals. This will be all single digit exposure to us because these are all globally dependent, where we currently don't have a very clear view because of the US action.
Could you explain the FII selling slide again?
So what I was trying to highlight is that what the numbers that we see in the media and the number that we discuss is predominantly the secondary market sale of FIs. That is just one side of the coin. FIs have invested an equally large amount into the IPO market in India, which has been a record inflow that we have seen last year. And if we have to net off that, the IPO inflows minus the secondary market sales, net FIs are not been a very big sellers. Also, what they sold in absolute amount is not even 3% of the holding. See, when an FI invested 10 rupees in India or 100 rupees in India 5 years back, 10 years back, 100 rupees today has become 500 rupees. So if they have to book profit and take 5 rupees or 10 rupees back, you might feel that they invested 10 and that 10 they're taking it back. No, that 10 has become 50. And from that 50, they're just taking 5. So net, whatever we have seen, is not even 3% of the FI holding. It is not that FIs are selling en masse and then that should be a sign of worry. This is what I was trying to explain and highlight, that they have redeemed or booked profits across emerging markets, including India. One, because they wanted to get into dollar assets. Second, there was slowdown in India, or the acceleration did not happen in India. Both of these factors led to this. Having said that, it's not an alarming number the way media highlights, because they are missing the IPO inflow that one has seen into India.
What about commodities, gold and silver, etc., despite the gold prices at this level?
We are not expert into precious metals, both gold and silver. My information is limited to what I have read, which is that if dollar continues to strengthen, gold will continue to do well. That's broadly what the consensus view is.
Yeah, so there are a few questions on the all cap portfolio and future outlook of the portfolio.
So yeah, on the all cap PMS side, anybody who has given us money or come in into the scheme over the last 6 months, they would be 70 to 80% deployed as of now. There will going to be 20% cash in their portfolio, which we are going to deploy over the next few months. Anybody who has come in over the last 6 to 12 months would have high single digit cash in the portfolio. Older client would be say 90-95% plus kind of deployed. We have taken some changes into the portfolio, as I was mentioning, based on the sectoral preferences that we have. One of the reasons that we underperformed was also in the raging bull market. There was cash in the portfolio, which had a cash drag, which in current times is indirectly helping us. And second, we were not chasing momentum. There was no defense, there was no PSUs, there was no railway stocks into the portfolio. We consciously did not get into that momentum. And going ahead, we feel there should be sector rotation. Some of the sector exposure that we have could be the better performing sectors going ahead, and that will also aid into the recovery. So the next, you can say 6 months or so, one should see the near-term performance for the outcome recovery.
Rural earning will have a tendency to increase in the future.
No, I didn't get you. Rural?
Rural earnings will have a tendency to increase in the future.
Yeah, in the near term, we are already seeing some green shoot of rural recovery happening. This was the first segment to get impacted, which has now moved to the middle class of India. And the first recovery also we are seeing from the rural. Monsoons have been good. Government MSP prices have also been good. And a combination of that is seeing first initial signs of pickup from a rural India, that too on a low base. We expect this sector to do well because this is also where the government focus is. The budget media might say that it's something which is pro-rural, not exactly, because what the budget is addressing is just the taxpayers of India, right? So which is predominantly the urban market. The rural market growth is coming predominantly from the MSP price hike, which was off-budget items, and also from the good monsoons and the good agri produce that we have seen in the current year.
When we can expect a small cap and mid cap rally to resume again?
See, there's always a cycle. Some years large caps do well, some years mid cap do well. Overall, at the end of a 3 to 5 year period, just because of the low base, mid and small caps tend to marginally or do better than what the large cap is. And that is something that we expect. We had a good 3.5 years of mid and small cap rally. It's been 6 to 9 months where the large caps are not done well, especially the broad nifty. Within large cap also, we are seeing decent corrections happening. I expect mid and small caps to do well once there's earnings acceleration. So that is still 2 3 quarters away.
Yeah, FIIs is buying in primary market. So whether newly listed stocks looking more attractive?
They have been invested in the IPO market. It is not that they have been buying in the primary market. Yeah, indirectly it is buying, but not on the screen. It is all case to case. There's no blanket reason to say that IPO stocks are much more attractive or new listing stocks are much more attractive than the existing listed stocks. In general, on the contrary, most of the IPOs happen at valuations which are on the higher side versus what the listed markets are. That's been the general trend in India. And that's the reason we are also very selective in the IPO market. Hardly 1 out of the 10 IPOs that come in, we would be investing in them.
View on private banks.
Already discussed that. Looking good to us, both the private sector financials, both fund-based as well as non-fund-based companies within the private sector.
Is there any systematic risk you foresee due to extensive DII flows in mid and small cap space?
Yeah, there's always this worry whenever market corrects or market is volatile, people go to the other extreme at what will happen when there's redemption. Right now, there's inflows. If somebody has to sell, there are no buyers. Who will buy the mid and small caps? It always happens. There will be some stocks which have gone up to where there was frothy valuations. They're bound to come down. There's still some good, decent mid and small cap where investor interest will always stay there. It's not going to happen that even if there's redemption, most of the funds have some cash holding that will see a catastrophe. And I don't expect that there's going to be a sustained redemption, if any, into this segment. People have made decent money, except for the people who have come in the last 6 to 12 months. So as we always say, the equity market should have a 3 to 5 year view at least. So if somebody is getting perplexed just by seeing the last 6 or 12 months returns, he's not the right person to be investing into equity markets. And overall, we have seen maturity in the retail class or retail investors in India. They understand the risk and the reward and the merit of taking a long-term view in equity markets. And I feel that the investors would be wise enough to not get worried just by near-term volatility. And overall, people have made money. It's not that they have not made money. They have made decent returns. Just that, yeah, last 1 year or so, they have not made in the mid and small cap. And that's pretty normal. You cannot have the same sector or the same segment delivering non-stop year after year, right? It has to take a pause. It has to take a break. That's what is going on right now.
View on mid cap versus large caps.
At Abacus, we never have the discussion whether large cap versus mid caps. For us, it is getting the best stocks within large caps, getting the best stocks within mid caps. It is more to be rightly invested than getting into large cap versus mid cap debate. So we don't have funds which can navigate between large cap and mid caps. There's always a range, like the all cap. It will always have 40 to 60% large caps. The balance is going to be mid cap. It is not going to happen that 90% will become large cap exposure, or when mid cap start to well, 90% will become a mid cap portfolio. We don't do that. We want to stay in a very disciplined way and stay true to the strategy that we are offering.
View on emerging opportunity strategy and future of the strategy.
Do you use?
Hello.
Yeah, Sharish. What was the question?
The view on emerging portfolio.
So emerging portfolio has done well, but in the last few months, where the market has been volatile, it should stabilize in the near term along with the markets, and expect the portfolio to do better than what the broad, mid, and small cap indices would be. So we are not, as I mentioned, not large cap versus mid cap kind of a thing. These are unique companies. We will be churning the portfolio, not to a great extent, but say two, three new stocks we will be buying in the current volatility, which offers better earnings visibility. And uh, on an absolute basis, the portfolio might not give the similar return what you have seen in the last 2 years, 3 years, because those are super normal, abnormal returns. More of normalized returns from year on from this strategy also.
Yeah, there are similar questions on diversified alpha portfolio.
It's early days for diversity alpha. It's a 1 year old strategy. It's a pretty broad-based strategy. So return for diversity alpha should be somewhere between all cap and the emerging opportunities portfolio. It's a 40 stock portfolio. It's going to be less volatile in versus the other two portfolios, and almost 40-45% of the overlap of diversity alpha versus the other two portfolios. So in that way, uh, the beta is lower of this portfolio, and it has more of new stocks which will take time to deliver. So return should be similar between the two strategies, what I feel for the diversified alpha.
Given the focus on aerospace and India investing in airports plus airlines, placing order for more airplanes plus government asking companies like Boeing, Airbus to buy components from India, do you see these companies will do well and India will increase their market share to become the manufacturing partner for airline manufacturing?
Aerospace industry is doing well, not just because of commercial airlines, but because of also the defense initiatives which the government has taken. So there's a clear momentum in manufacturing of aerospace spares, components, parts in India, and not just for local consumption, but also for the export market. So this sector is doing well, and I see it continuing to do well.
Your view on EPC industry and is because of continuous government capex.
So we are positive on EPC companies. We own three, four of them in our portfolios. We expect the government spending to accelerate starting on the current quarter itself, which will have a good positive impact on the order business positions of most of these companies, and this company should continue to do well. So we are pretty positive on this sector.
What do you think of solar industry? And some of them don't seem to be doing well.
So the sunrise sector, it will do well. Right now, globally, solar sector is seeing headwinds wherever China is exporting. So China is exporting solar cells and modules at, you can say, a very competitive pricing, which most of the local manufacturers, not just in India, even in US, can compete with, and hence there's anti-dumping duty. There's massive overcapacity in China because of which both the solar as well as module prices have crashed. Even lithium prices have crashed. So if you look at the cost benefit analysis now, it makes much more sense to have a solar power installed than you can say conventional power being installed, and hence the spending on the sector will continue. The companies that are doing well are the ones that are manufacturing and doing installation of the solar panels or the windmill panels, and you can say in a very systematic way. Companies who are over leveraged in the past or have been receiving end because of this Chinese oversupply, the one that are struggling. But most of the companies in this sector are doing well, and the outlook remains positive because that's clearly one of the strong focus area, not just for the Indian government, but for most of the governments globally.
When is the right time to invest in this market? There is a lot of fear. What will be your guidance? Obviously, investors will look for some good returns within next 2 to 3 years.
The best is to stagger your investments. You can't exactly pinpoint if one has to invest. As I mentioned, the near term could be volatile, so don't come in with full amount right away, but stagger it over the next 3-4 months. I'm not saying stagger it over the next 12 months because whatever right or wrong has to going to happen because of Trump policies and the retaliation and extra that all is going to get implemented or visible in the next few months, and hence one should be using the current volatility to build a good portfolio, and hence best is to stagger over the next few months and to come in.
What do you feel about the metal sector, especially steel future in India?
So we have a positive view on the metal sector, especially post the China stimulus. Right now, it is neutral, just waiting for how the Chinese government reacts to what the Trump government is doing. Based on that, we'll be forming a view. But as of now, it's a neutral to say mildly positive on the metal sector, which includes the steel also. We are more bullish on stainless steel than carbon steel.
If investors want to invest in our strategy, all cap, emerging, diversified alpha, what would be the thought process and how we will build the portfolio now?
As I mentioned, bets says to stagger and come in. Whatever inflow that we get, we as our policy, we don't overnight deploy. We never did it 2 years back or 3 years back also when it was the bull market. We are not doing it right now also when the markets are volatile. We'll take our time. In the next week or so of the money coming in, 40 to 50% of the portfolio value will get deployed. In the next month to 2 months, 60, 70, 80% will get deployed. For the next 3 to 6 months, there will be full deployment. That's broadly what the deployment policy is what we have currently. This view can change based on how the market reacts, but as of now, this is what the thought process is.
Yeah. So there are few questions on our AIF strategy. So just because of the regulatory purpose, we may not be able to answer those questions. So if you have any questions regarding your AIF investment with Abacus, please drop a mail to us. We'll try to revert those questions. Thank you. So Aman sir, any final words from your side so we can close the webinar?
Sure. So the concluding remarks would be, if I have to conclude, the current uncertainty, which is predominantly happening because of the US government policies and the currency impact that it is leading to, has led to the volatility in the market, along with the slowdown. The global uncertainty, I feel, will get addressed in the next few months, so that will be taken off in the next few quarters. Expect the demand scenario in India also to improve, predominantly because of the initiative the government has already taken. So it's not a hope story that government will act, something will happen. Government has already acted, just that the benefits of that will be visible eventually. It cannot happen overnight, and hence we are confident that the things will start to recover. And once it recovers, the investors and the equity markets will definitely take a note of the same. It's a fairly priced market right now. Stocks or sectors which are overpriced, 50, 60p in the corrections become 30, 40p, still not an entry level P, but stocks which are 20, 30p are now become 15, 20p, which is definitely worth considering now. And that is what our focus here would be. So it's not a cheap market. So don't expect a similar kind of return that people have made in the last 3, 4 years when it was a great bull market. From a fairly priced market, expect a fair return and a non-linear return, but over a 3 to 5 year period, I still feel a decent double-digit return, a mid double-digit return is possible from Indian equities, and that's what one should be hoping for. But then always an upside potential that the markets can deliver much higher than what we are expecting, because it's also a factor of sentiment, it's also a factor of news flows, it's also a factor of what the governments are going, the policy action, which can all surprise on the positive also, which is also one of, you can see the option value in equity markets anywhere in the world. So that's what you can see the pros and cons or the risk reward equation in equity markets right now is. Don't come in one shot. It's markets might take time correction or be volatile in the near term, stagger it over the next few months, and just wait on for the economic can say acceleration to come in, which once it is here, I'm sure the equity markets will reward that.
So thank you everyone for joining. It was a pleasure having a word with you. I'm conducting the webinar. Thank you. If you have any questions, please drop us a mail at service@abackusinvest.com. Thank you.
So thanks everyone, and have a great evening ahead. Thank you.